When the US dollar goes down, everything else tends to go up. That's part of why so many are convinced the dollar index, or DXY, is heading lower. It's the only way everything else goes higher. But what if they're wrong? What if the dollar is about to strengthen and send everything else down? Today, we're taking a deep dive into the US dollar, looking into its history, the forces shaping its recent performance, and what it could all mean for the markets. My name is Louis, and you're watching the Coin Bureau. Now, before we dive in, there is something I need to make clear here, and that is that I am not a financial advisor, and nothing in this video should be considered financial or investment advice. This is educational content intended to inform you about the US dollar. If that sounds good, make sure to smash that like button, and let's get into it. Now, to really understand the US dollar, we need to go back to the beginning of money itself. For most of history, money wasn't just a medium of exchange. It was also a tool of control, a way for rulers to hold power over their people. And of course, when you have centralized control, you get instability. After World War I, attempts to revive the precious gold standard collapsed. Central banks hoarded gold, global cooperation broke down, and the result was a monetary system that became deeply deflationary. Things only got worse during the Great Depression, compounded by the Smoot-Hawley tariffs of 1930, which slashed global trade by 2/3. The breaking point, though, came in 1931, when the Bank of England abandoned the gold standard and devalued the pound by about 25%. That move set off a race to the bottom, as countries everywhere ditched their gold pegs in an attempt to export their economic pain. By the end of World War II, the United States was the only major economic power left standing. Capital had flooded into the country, and after the Gold Reserve Act of 1934, which raised the price of gold to $35 an ounce, the US controlled about 75% of the world's gold reserves. That dominance set the stage for what came next. In July 1944, delegates from 44 nations gathered in the New Hampshire town of Bretton Woods to design a new monetary system. The result was a gold exchange standard that placed the US dollar at the center of the financial universe. The dollar was pegged to gold at $35 an ounce, and every other major currency was pegged to the dollar. On top of that, the US guaranteed that foreign governments and central banks could convert their dollars back into gold. For a time, this system worked, but it carried a fatal flaw. US military spending and ambitious domestic programs flooded the world with dollars. As French President Charles de Gaulle famously put it, this was, quote, exorbitant privilege. America could finance its deficits simply by issuing the very currency other countries were forced to hold as reserves. Eventually, the math stopped adding up. It became clear that the US no longer had enough gold to back all of the dollars in circulation. So, on August 15, 1971, President Richard Nixon pulled the plug, ending gold convertibility and bringing the Bretton Woods system to an end. That decision gave birth to the fiat currency system that we live in today, where money is backed only by the issuer's monopoly on power. But the dollar didn't fade away. Quite the opposite. In 1974, the US cut a deal with Saudi Arabia that required oil to be priced exclusively in dollars. This petrodollar agreement hardwired the greenback into the foundations of global trade, particularly the energy trade. That dominance is what we measure today with the DXY, the dollar index. For those unfamiliar, the DXY is a measure of the US dollar's value against a weighted basket of 6 other currencies, with the euro and the Japanese yen making up the bulk. That said, the DXY is also a bit outdated. It doesn't include the Chinese yuan or the Indian rupee, currencies that matter far more to global trade today than, say, the Swedish krona, which is also in the DXY. Even so, the DXY remains the go-to yardstick for measuring the dollar's strength, and the system it reflects is still very much an exorbitant privilege. The US can issue mountains of debt knowing that foreign governments and investors will buy its treasuries, or that the Federal Reserve itself will step in. The result is that the dollar has become the financial bloodstream of the global economy. And despite all the talk about its decline, it still underpins most of global trade and is likely to remain dominant for decades to come. So, when we talk about the US dollar, what we're really talking about is the DXY. And to really understand the DXY, we need to look at the other currencies in the basket, specifically the structural weaknesses that tend to weigh them down. Let's start with the Japanese yen. Japan has the highest debt to GDP ratio in the developed world, or 260%. To put that into perspective, the government spent over a fifth of its budget just on interest payments in 2023 alone. And every small rise in bond yields sends those payments soaring. Unsurprisingly, this has shaken confidence in Japan's financial stability. Yields on long-term government bonds like the 30-year JGB have surged to record highs, a clear sign that investors are getting nervous about the country's long-term potential. But the problems don't stop there. The Bank of Japan is stuck. Inflation has been above its 2% target for 3 years straight, sitting at 2.7% as of August of 2025. Under normal circumstances, they'd raise rates to cool things down. But with such a mountain of debt, higher rates would trigger a fiscal crisis. Economists call this fiscal dominance, when a central bank's policy is dictated not by inflation, but by government debt. This trap locks the BOJ into ultra-low rates, which fuels the yen carry trade, where investors borrow yen at negligible rates and sell it to buy higher-yielding assets abroad. It's essentially a trillion-dollar liquidity machine that constantly pushes the yen lower. And we saw just how dangerous this was in the summer of 2024. The BOJ made a small rate hike, and on August 5th, markets went into meltdown. Yet, even after that shock, rates are still pinned near the floor, which means the yen carry trade is very much still alive. That whole fiasco is something we covered in detail in another video, which you could find right over here. Up next comes the British pound. The UK faces a toxic mix of sticky inflation and deteriorating public finances, with 30-year gilt yields at levels not seen since 1998. And FYI, gilts is basically just a British word for bonds. Now, if the near future for the UK looks bleak, the long-term picture looks even worse. Under pessimistic forecasts, the UK's national debt could balloon to nearly 274% of GDP by the 2070s. And with debt already hovering around 100% today, that's hardly the kind of backdrop that inspires confidence in the pound. But these problems pale in comparison with those of the euro. In countries like Austria, France, and even Germany, foreign investors have been choosing equities and gold over sovereign bonds. Meanwhile, European leaders have recently committed to spending 5% of GDP on defense. That's a massive bill, and to cover it, the ECB will likely have to step in with large-scale bond purchases. In other words, quantitative easing. And we know QE puts downward pressure on a currency. And if those commitments aren't met, the fallout could be even worse. President Trump has made it crystal clear that Europe won't be getting a free pass if it fails to spend on defense. So, whether it's the yen, the pound, or the euro, the story is the same. Profound structural problems that point to continued long-term weakness against the dollar. That said, these problems aren't unique. The US isn't exactly keeping its own fiscal spending under control either. The difference is that, compared to every other currency, the dollar is still likely to be the last one standing. Simply put, it's the best of a bad bunch. Now, so far, we've seen that the dollar looks strong mainly because its rivals are weak. But it isn't just strong by comparison. It's strong at a fundamental level. To see why, we need to step back and look at how money is actually created. Contrary to popular belief, most money isn't printed by governments. Money is usually loaned into existence. Most money is technically debt. Logically, this means that there's constant demand for US dollars to pay down interest on, well, all the US dollars that were created via borrowing. That's why macro analyst Brent Johnson believes that it's dollar strength that will eventually break the system, not dollar weakness. To put things into perspective, estimates put global dollar-denominated debt at over $50 trillion. Just servicing that mountain of debt likely costs more than $1 trillion every single year. Until it's repaid, nobody can simply walk away from the dollar. And this is where things get interesting. When you see the dollar weaken, foreign powers pile on more dollar debt because it's cheaper to do so. But the US is the only country with the power to print the dollars needed to repay it. The practical effect of this dynamic is that it reinforces America's financial grip on the world, which is really crazy to consider. What this means is that an oversupply of dollars is necessary for the system to continue functioning. If there's a shortage of dollars, that's when the short squeeze begins. Foreign entities are forced to sell assets, sometimes even their own currencies, just to acquire the US dollars that they need to pay down the debts. And as the dollar maturity wall hits more and more economies, refinancing that debt becomes brutally expensive. Which leaves us with a sobering conclusion. The only true path to de-dollarization is deleveraging, and deleveraging means pain. In plain English, the world as a whole needs to stop borrowing dollars. A rising dollar forces that painful process. A falling dollar, by contrast, only encourages more borrowing and re-dollarization. And that's why every time the DXY climbs, the pressure ratchets up, draining liquidity out of other assets and pulling it back into the dollar. So, if we're entering a scenario where the world is experiencing a shortage of dollars because of refinancing issues, will the US government step in and stop it? Well, a few years ago, maybe. But today, things look very different. We're no longer in the era of coordinated bailouts like we saw in 2020 and 2022. Global debts are far larger now, and US politics has shifted under President Trump's America First agenda, which is steadily dismantling the post-war rules-based order that held things together for decades. At the center of all of this uncertainty is the battle between the president and the Federal Reserve. On paper, the Fed's mandate is price stability and maximum employment, but in reality, its main job is to protect the US-dominated financial system, because if the dollar-based system goes down, the US government likely goes down with it. That's why many argue that central bank independence is more myth than reality. And when you look back, the Fed's actions really back this up. For the last 50 years, its policies have assured one thing: the dollar should gradually weaken. A weaker dollar is the default because it makes global growth possible and ultimately increases US dominance. But if the dollar starts getting stronger, the opposite will occur, and that's the risk that we could now be facing, even if today's dollar weakness makes it hard to see. Meanwhile, the rest of the world is searching for an escape hatch. The BRICS countries are stepping up trade talks and laying the groundwork for alternatives to the dollar system. They're not ready to rival it yet, but Trump's tariff wars have only accelerated the push, with more nations looking to shield themselves from the volatility of the so-called Trump order. The US, of course, sees this too. Trump has even said that losing the dollar's reserve status would be, quote, like losing a war. One way to prevent that is actually through stablecoins. After all, nearly 99% of them are pegged to the US dollar and backed by US treasuries, which means every single transaction is effectively a vote of confidence in the greenback. It also has the practical effects of lowering bond yields, which also weakens the dollar. And with the Genius Act now passed, the US has laid the legal groundwork to lock in that advantage, reinforcing dollar dominance across the digital economy while creating even more demand for its debt. We covered this in detail in a separate video, which you can check out right over here. And this brings us to the most important question. What does all of this mean for the markets? Well, to start with, let's look at the technicals. At the time of recording, the DXY looks primed for a breakout in either direction, and it's likely to break down as a result of the recent US government shutdown. Hedge funds and asset managers are betting heavily against it. In fact, positioning is the second shortest it's been in 2 decades, which could result in a short squeeze. What's spooky is that we've seen this setup before. In the early stages of a financial crisis, the dollar often dips. It happened in September of 2008, in March of 2020, and again in April of 2025. Investors tend to pull their quote-unquote play money home first, which pushes the DXY lower. But once the slowdown turns into a real crisis, the script flips. Suddenly, there's a scramble for dollars to service debt, and the DXY rips higher. This is sobering considering the squeeze lower caused by the recent US government shutdown. It suggests that this squeeze lower could be temporary and that the DXY could start rallying again sooner than people think. And when the DXY starts pushing higher, all those borrowed dollars will become more expensive and capital will rush back into the dollar, driving it higher. And when that happens, the squeeze will become too much to bear and global markets could crash. But while this might sound grim, the bottom line is that the global financial system cannot run on a strong dollar. At some point, a forced revaluation, something like a modern-day Plaza Accord, will have to happen to push the dollar down. And when that moment comes, everything will rally, as investors understand the Ponzi will continue. That's when gold and possibly Bitcoin will shine brightest as forms of money that can't be debased. Yet for now, the world seems to be positioned for the dollar to keep falling in the short term. But if that consensus is wrong, we could be in for a very nasty surprise. And if you think that this is bad, wait until you hear how the very foundations of the Western financial system are beginning to creak, something that we covered in detail right over here. And if you haven't subscribed yet, you could do that right over here. Thank you so much for watching, and we'll see you again very soon. This has been Lewis, signing off.